They waited until everyone was distracted. They executed the largest position flip in commodities history while the world watched political theater and stock market noise. And then on October 8, 2025, a routine purchase order exposed what they'd been hiding. India placed an order for 1,000 tons of silver. Standard industrial procurement, the kind of transaction that happens every month without headlines. But this time, the system didn't just hiccup. It froze completely. Within hours, London silver markets locked up. Lease rates detonated from 0.25% to 200% overnight. Swiss refiner Metalor, one of the largest precious metals processors on Earth, announced they cannot return silver until January 2026. The U.S. Mint simultaneously declared coin shortages. And in that single moment, a secret that's been buried for 2 decades became impossible to hide. J.P. Morgan Chase, America's largest bank and a convicted precious metals criminal, just executed the greatest financial betrayal in modern history. Between June and October 2025, they closed a 200 million-ounce paper short position while simultaneously accumulating 750 million ounces of physical metal. Let that sink in. The same institution that spent 17 years crushing silver prices through what federal prosecutors proved was systematic fraud suddenly became the world's largest silver hoarder. They didn't exit their manipulation. They weaponized it. They flipped sides entirely, leaving their co-conspirators trapped in collapsing short positions, now losing billions per day. By December 15th, silver hit $63.95 per ounce. That's not just a record. That's obliterating the legendary 1980 Hunt Brothers peak that traders called untouchable for 45 years. More than doubling in 12 months while most people were watching elections and inflation headlines. But here's what matters. 5 major banks are now trapped on the wrong side. HSBC, Deutsche Bank, Scotiabank, UBS. Former J.P. Morgan partners holding massive shorts that hemorrhage $179 million for every single dollar silver climbs. Do the math. Silver went from $30 in early 2025 to $64 by December. These institutions have racked up collective losses exceeding $6 billion. $6 billion on a metal most Americans never think about. And unlike stock positions they can dump, these are derivative contracts backed by physical metal that doesn't exist in quantities sufficient to cover. They are mathematically trapped in a position that becomes exponentially more expensive every hour. This is where it turns dangerous. Pop quiz. When was the last time America's biggest bank paid nearly $1 billion in criminal fines, then doubled down on the exact same market? Never. Because that's not what happened. In 2020, J.P. Morgan paid a record $920 million settlement for precious metals manipulation between 2008 and 2016. Federal prosecutors proved they systematically suppressed gold and silver through thousands of illegal trades. But here's the twist. They weren't exiting the game. They were preparing for endgame. According to CFTC data, J.P. Morgan maintained significant short positions through 2024, working alongside the same banking cartel they'd manipulated with for years. Then something shifted in June 2025. China's government documents published June 23 ordered all ministries to develop domestic silver mining, reopen closed facilities, and systematically link gold and silver in national reserves. Within weeks, J.P. Morgan began the most aggressive position reversal in commodity history. Think about the coordination required. Closing 200 million ounces of paper shorts means buying back contracts from counterparties. Admitting you were wrong. Paying up. Simultaneously accumulating 750 million ounces of physical means securing actual bars from refiners, miners, existing stockpiles. We're talking roughly 23,000 tons changing hands in under 5 months while the market remained completely blind. How does the world's most scrutinized bank flip 500 million ounces without triggering price spikes that would expose the move? The answer reveals why India's October order broke everything. J.P. Morgan wasn't buying on transparent, regulated exchanges. They were securing physical through private channels, forward contracts, strategic relationships built during manipulation years. They weaponized the same suppression network they created, using artificially low prices to accumulate before other banks realized what was happening. But there's only so much physical silver in existence. When India, the world's second-largest consumer, placed that 1,000 tons order, The market ran out of immediate teledeliverable metal. This is where the system fractures. Silver lease rates measure the cost of borrowing physical metal for delivery. Normal conditions, rates hover 0.25 to 0.5%. Storage and insurance costs. When rates spike to 200%, as they did October 8, it screams shortage. Refiners like Metalor don't announce months-long shutdowns because business is slow. They announce shutdowns because they loaned out metal they don't possess and cannot recover it from entities they loaned to. According to the Silver Institute's 2025 analysis, global supply faces its fifth consecutive annual deficit. Industrial demand alone consumed 1.2 billion ounces in 2025. Solar, EVs, military applications requiring silver's unique conductivity. Mine production delivered only 830 million ounces. That's a structural shortfall of 95 million ounces for the year. Add the cumulative deficit of 820 million ounces built since 2021, and you understand why JP Morgan moved so aggressively. What India's order revealed wasn't temporary squeeze. It was proof the paper system financial institutions have operated for decades is collapsing under real-world demand. While other banks maintained shorts assuming prices would retreat, JP Morgan recognized something fundamental changed. This is no longer theoretical. The question is simple. If America's largest bank with access to the best intelligence, deepest relationships, longest manipulation history determined they needed to own physical silver instead of betting against it, what do they know that we're only now discovering? The U.S. Mint's concurrent shortage wasn't coincidental. When the primary government entity producing silver coins tells Americans they cannot meet demand while the world's largest bank secretly accumulates 750 million ounces, we're watching a shift in precious metals markets most won't understand until it's too late. JP Morgan didn't flip because they became bullish on silver as investment. They flipped because they received intelligence the physical market was breaking. Being caught short when that happens would cost exponentially more than the billions they spent securing metal. This isn't speculation. This is documented position data, verified delivery crises, mathematical supply-demand imbalances creating a situation where institutions that manipulated prices down for 17 years now face catastrophic losses because one conspirator saved themselves first. And this window is already closing. Let's talk about what a $920 million fine actually means in banking. JP Morgan paid this record penalty September 2020 after prosecutors spent years proving something extraordinary. Between 2008 and 2016, traders at America's largest bank placed thousands of fraudulent orders in gold and silver with zero intention of executing. They'd place massive buy orders to spike prices, then cancel and sell at inflated levels, or flood markets with fake sell orders to crash prices, then buy at artificially suppressed levels. Prosecutors called it spoofing, a pattern so systematic it could only be institutional strategy, not rogue traders. But here's what headlines missed. The DOJ case only covered 2008 through 2016. Manipulation didn't stop. It evolved. According to CFTC data, JP Morgan maintained concentrated short positions through 2023 into 2024, working within the same banking consortium that collaborated on suppression for years. What changed wasn't their willingness to manipulate. It was their calculation of when to stop suppressing and start positioning for the snapback. Think about the strategic brilliance. For 2 decades, JP Morgan and conspirators kept silver artificially below fundamental value. Every time industrial demand increased or investment interest picked up, massive paper shorts flooded COMEX, creating artificial supply that overwhelmed real demand. This contained prices even as physical markets faced increasing deficits. But artificial suppression creates a coiled spring. The longer you compress it, the more violently it rebounds when released. Consider the intelligence JP Morgan accessed that other banks didn't fully appreciate. June 23, 2025, Chinese ministries published a directive ordering systematic development of domestic silver mining, reopening closed mines, strategic linking of gold and silver, in national reserves. This wasn't subtle. China publicly announced intention to treat silver as strategic resource in their broader de-dollarization campaign, while Beijing continued exporting refined silver to global markets, keeping prices temporarily stable. They simultaneously accumulated physical through state-backed entities that don't appear in Western tracking. JP Morgan's reversal starting June 2025 wasn't coincidence. It was confirmation they received intelligence the game was changing. When a nuclear-armed economic superpower declares a metal strategic to national security, banks with deep intelligence connections understand what's coming. China had systematically reduced dollar exposure, accumulated gold reserves, built alternative payment systems for years. Adding silver to that framework meant Western manipulation through paper contracts was facing coordinated challenge that couldn't be suppressed anymore. Once this starts, it doesn't stop cleanly. Examine what happened on COMEX itself, the primary venue where silver futures trade and price discovery theoretically occurs. Fall 2024, registered silver inventory stood at approximately 140 million ounces. Physical bars and COMEX approved warehouses available for delivery against contracts. By December 2025, inventories collapsed to 116 million ounces. That's a decline of 24 million ounces, roughly 17% in just over a year. Meanwhile, open interest on silver futures sat at 141,580 contracts. Each contract represents 5,000 ounces. Do the math. 707.9 million ounces of paper claims against 116 million ounces of physical metal available. That's leverage of 6 to 1. For every ounce of actual silver, there are more than 6 ounces of paper contracts claiming ownership. Under normal conditions, this works because most traders close for cash rather than demanding delivery. Exchanges assume only 2 to 3% ever request physical. But what happens when that assumption breaks? What happens when even 15% decide they want metal instead of cash? The math becomes catastrophic. 15% of 707.9 million equals 106.2 million ounces demanded, but only 116 million exists in registered inventory, much already spoken for through existing obligations and storage agreements. If just 3 months of contract holders demand physical instead of paper promises, especially given price momentum and supply concerns, COMEX faces the first precious metals default in modern financial history. They literally cannot fulfill obligations without breaking contracts or forcing cash settlement at prices far above spot. This is where JP Morgan's strategy becomes truly ruthless. By accumulating 750 million ounces of physical, more than 6 times entire COMEX inventory, they position to profit from the very delivery crisis their manipulation created. For 17 years, they suppressed prices through paper shorts. That discouraged mining investment, keeping production low, discouraged industrial users from building strategic stockpiles, making them dependent on just-in-time delivery. Convinced investors silver was dead, ensuring minimal accumulation outside industrial necessity. Now that physical market is breaking, JP Morgan owns more deliverable silver than anyone on earth. While HSBC, Deutsche UBS, Scotia maintained shorts expecting retreat, JP Morgan understood something critical. Banks who borrowed physical to deliver against shorts have no way to return it if lenders demand it back. According to Bank for International Settlements data on metals leasing, Western banks entered thousands of agreements where they borrowed metal at low rates, sold it to suppress prices, assumed they could buy back later at similar levels to return it. That assumption just shattered. When lease rates exploded from 0.25 to 200% October 8th, it revealed lenders demanding silver back and borrowers unable to acquire without driving prices dramatically higher. Metalor's announcement they won't return until January 2026 confirmed they leased metal they no longer have immediately available. They need months to mine new supply or buy back from entities they sold to. Doing so at current prices locks in massive losses on lease agreements. Here's what makes JP Morgan's betrayal particularly calculated. They use their short position as a buying weapon. When you hold massive shorts and decide to close, you're entering as buyer. But if you coordinate that buying with physical accumulation through private channels, you cover shorts while driving other banks deeper into losing positions. Every time JP Morgan bought a contract to close shorts, it pressured price upward, making life more expensive for banks still short. Because JP Morgan already secured physical through forward contracts and private deals, they didn't care about rising prices. They welcomed them. The U.S. Geological Survey's 2025 assessment highlights something Americans should understand. Domestic production declined 40% since 2015, while industrial applications requiring silver increased 78% over the same period. We consume far more than we produce. That deficit compounds annually. Solar manufacturing alone consumed 202 million ounces in 2025, a single application using nearly 25% of global production. Add EVs, 5G infrastructure, military electronics, medical devices, water purification, and you understand why industrial users are panicking. When JP Morgan paid that $920 million fine in 2020, they essentially bought insurance against future prosecution while learning exactly how regulators track manipulation. They didn't stop manipulating. They perfected it. The final phase wasn't suppressing forever. It was suppressing long enough to accumulate physical they'd need when paper collapsed. Now they're watching former conspirators face the same fate as every previous attempt to fight fundamentals with unlimited paper. Deutsche, HSBC, UBS, Scotia aren't small institutions. They're global systemically important banks with trillions in assets. But their silver shorts, manageable at $20 to $25 per ounce, have become existential threats at $64 with no ceiling visible. Every additional dollar represents another $179 million in collective losses. Every day maintaining positions, the mathematical impossibility of covering becomes more obvious. Every attempt to close by buying contracts drives prices higher, accelerating losses in a vicious cycle with no gentle exit. This isn't the first time major banks got caught in precious metal squeeze, but it's the first time one conspirator escaped by abandoning the others. And that changes how this ends. Let's do math that should terrify anyone holding paper contracts. Silver's 5-year cumulative deficit reached 820 million ounces. Documented shortfall between what the world produced and consumed 2021 through 2025. Industrial demand hit 1.2 billion ounces in 2025, while mine production delivered only 830 million. Structural imbalance compounding every year. 2025 added another 95 million to the deficit. Where did missing silver come from? Existing stockpiles. Recycling. Most critically, banks leasing metal they assumed they could replace later at similar prices. That assumption is now mathematically impossible. Bank of America published targets of $50 by year end 2025. Saxo Bank projected $36 to $40 conservative. Even J.P. Morgan's own analysts issued reports suggesting sustained levels above $45 before industrial buying accelerates. But those forecasts don't account for forced covering of the 217 million ounce commercial short still held by HSBC, Deutsche, UBS, and conspirators. Think what forced covering means in a market already facing physical shortages. When you hold short, you've borrowed an asset, sold it, promised to buy back later to return it. Normal liquid markets, covering is straightforward. Buy equivalent contracts, close position. But silver isn't in normal liquid state. When India's 1,000 tons order froze London in October, it revealed attempting to buy large quantities drives prices exponentially because metal isn't available in sufficient quantities at current levels. Multiply India's order by the scale trapped banks need to cover. CFTC data shows commercial shorts collectively need to buy back 217 million ounces. That's 6,750 tons. India's 1,000 tons broke the market. What happens when banks need nearly 7 times that in compressed time frame? Analysts who studied previous commodity squeezes, including 1979 to 1980 Hunt Brothers run, suggest forced covering in deficit markets doesn't follow linear progression. It follows exponential curves. Hunt Brothers pushed silver from $6 to $48 by accumulating paper contracts representing about 200 million ounces, roughly current commercial short size. But they didn't own physical, making them vulnerable to margin calls and regulatory intervention. January 21, 1980, COMEX introduced Silver Rule 7, regulation prohibiting new long positions while allowing unlimited shorts. This destroyed Hunt paper position, triggering margin calls they couldn't meet. March 27, 1980, Silver Thursday, prices crashed from $48 to $10.80 as Hunts were forced to liquidate, eventually declaring bankruptcy. Here's the critical difference between 1980 and 2025. J.P. Morgan owns 750 million ounces of physical that cannot be margin called, cannot be confiscated, doesn't require daily settlements. Hunt Brothers held paper promises that evaporated when regulators changed rules. J.P. Morgan holds actual bars and vaults they control, position becoming more valuable as paper system breaks. Banks trapped short aren't speculators who can walk away. They're institutions with fiduciary obligations, derivative exposure, clients demanding delivery they cannot provide. When you adjust 1980 peak of $48 for inflation using Bureau of Labor Statistics data, you get roughly $150 to $180 in 2025 dollars. We're currently at $64. Silver would need to rise another 135 to 180% just to match inflation-adjusted Hunt peak. But Hunt's operated in surplus market where production exceeded demand. Today's market faces fifth consecutive deficit, with industrial applications consuming more than exists in above-ground stockpiles. Setup for spike isn't just comparable to 1980. It's fundamentally more extreme. Consider what's driving demand beyond speculation. Solar consumed 202 million ounces in 2025, projected to grow 25% annually through 2030 as countries accelerate renewable transitions. Every panel requires 20 grams of silver for conductivity that cannot be substituted without significant efficiency losses. Electric vehicles used 72 million ounces, each EV requiring nearly twice the silver of traditional vehicles for electrical systems, charging infrastructure, battery management. 5G deployment consumed 38 million for high-frequency transmission requiring silver's superior conductivity. But here's where it gets concerning for national security. Military applications consumed 24 million for missile guidance, radar, communications, next-generation weapons platforms. Pentagon cannot substitute copper or aluminum. Silver's unique properties are mission-critical for systems functioning in extreme conditions. When J.P. Morgan accumulated 750 million while others maintained shorts, they cornered market on metals strategic to everything from renewable energy to national defense. And this window is already closing. Talk about timing. The window for action is compressing rapidly. Federal Reserve cut rates quarter point December 2025. Signal of economic slowdown concerns while inflation remains elevated. Lower rates reduce opportunity cost of holding metals that don't pay interest. But more importantly, incoming Trump administration signaled intentions for significant tariffs on imports, particularly China. Every analysis of tariff impacts shows same result. They increase domestic prices. Higher inflation. Higher inflation combined with lower rates creates perfect storm for precious metals acceleration. When people lose faith in currency purchasing power, they historically move to assets with intrinsic value. Gold hit records in 2025 for this reason. But gold's already $2,800 plus per ounce, inaccessible for many retail investors. Silver at $64 offers similar protection with lower entry point. That's why retail demand for physical coins and bars exploded even as most remain focused on stocks and bonds. Here's the progression that should concern anyone not already positioned. Current price $64. Conservative institutional targets suggest $80 to $100 by mid-2026 based purely on supply-demand fundamentals. Add force covering of 217 million ounces and analysts who modeled similar squeezes suggest prices could spike $100 to $150 by Q1 2026. If even 5% of COMEX holders demand physical during December-January settlement, historically heaviest delivery months, exchange would face failures pushing prices above $200 as industrial users panic by outside broken futures markets. Metalor already announced they won't return until January 2026. That's not production delay. That's acknowledgement they committed metal they don't possess and need months to acquire. December through January represents COMEX's primary delivery period when most contracts demanding physical come due. If Metalor, one of the world's largest refiners, cannot deliver until January at earliest, what happens to thousands of other obligations due same time frame? COMEX has mechanisms for handling failures. Cash settlements. If exchange cannot deliver physical against contract demanding it, they offer cash at spot plus small premium. But mechanisms were designed for occasional isolated failures, not systemic breakdowns affecting hundreds simultaneously. More importantly, cash settlements destroy price discovery. If investors can't trust buying a contract gives right to receive silver, they'll stop trading that exchange and physical premiums disconnect entirely from paper prices. We're already seeing early evidence. Physical coins from U.S. Mint now trade at premiums 25 to 40% above spot. If spot is $64, actual coins cost $80 to $90. Premium reflects market pricing, delivery risk, and physical scarcity paper doesn't capture. When premiums reach 50 to 100% above spot, which happened in previous squeezes, it signals paper prices became meaningless for anyone acquiring metal. At that point, industrial users needing silver for production pay whatever necessary, driving physical transaction prices far above any exchange quote. Let me put opportunity and risk in perspective for those protecting purchasing power. If you're holding paper silver ETFs, futures certificates promising you own silver without physical possession, you're exposed to counterparty risk, becoming more dangerous daily. When JP Morgan flipped short to long, they didn't buy ETF shares. They accumulated physical bars. When China issued June 23 directive treating silver as strategic, they didn't increase paper exposure. They ordered domestic production and physical accumulation. Institutions with best intelligence and longest manipulation history choose physical over paper. That should tell us something about which form maintains value when paper faces delivery failures. Those failures aren't hypothetical future concerns. They're happening now. India's October order froze markets. Metalor suspended returns until January. U.S. Mint declared shortages. Lease rates spiked 800-fold overnight. These aren't signs of a healthy functioning market. These are warnings physical supply chain is breaking under stress that will only intensify. Hunt brothers tried cornering with 200 million ounces of paper and lost everything when regulators changed rules against them. JP Morgan accumulated 750 million ounces physical, more than 3 times Hunt positioning to profit when regulators inevitably acknowledge paper cannot deliver on promises. Difference between those outcomes isn't luck. It's understanding physical possession beats paper promises when markets break. For Americans watching currency lose purchasing power, stock market reach valuations defying fundamental analysis, government add trillions to debt our children inherit. Precious metals represent one of few assets with intrinsic value that cannot be printed, diluted, defaulted on by institutions. Silver specifically offers protection at price accessible to regular investors who don't have $2,800 plus for single ounce of gold. But accessibility only matters if you can acquire it. Window between recognizing supply crisis and acting is closing rapidly. December through January historically when COMEX delivery pressures peak. Swiss refiners already out until January. U.S. Mint already experiencing shortages. If even small percentage reach same conclusion JP Morgan reached in June, that physical is preferable to paper promises, premiums spike beyond what most can afford and available supply disappears entirely from retail channels. This isn't fear-mongering. This is mathematical analysis of supply deficits, documented institutional positioning, observable market breakdowns pointing to same conclusion. Paper silver system operated for decades is facing structural collapse.